Welcome to this session on managing student loans presented by the Credit Abuse Resistance Education Program, CARE for short. My name is Paul Bonapfel. I'm a United States bankruptcy judge for the Northern District of Georgia, based in Atlanta. With me is Shayna Steinfeld, a board-certified bankruptcy lawyer who practices consumer and business bankruptcy law in Atlanta. The CARE program has been organized by bankruptcy judges and lawyers to provide information and help for high school students to educate them about the proper use of credit as they approach graduation from high school and financial independence. Today, we're going to talk with you about something important for your future: student loans to help finance your college education. Of course, your college planning includes picking the colleges you're interested in, considering the education and degrees they offer, preparing your applications for admission, and thinking about parties, social life, and football and basketball games. And you know that going to college will require money for tuition, books, and room and board, as well as your other living expenses. Unless you're independently wealthy or have a rich relative, you're going to have to figure out how to pay for all of that. One way to do that is through student loans. Getting loans that don't require any payments while you are in college is one thing. Paying them back is another. We're here to encourage you to think carefully about how you are going to manage your student loans, because you will have to pay them back. The time to think about that is now. So for starters, you know that college is not cheap. The average cost for just tuition and room and board at an in-state public college is about $22,000. If you go to a public college out of state, it's over $38,000. A private college will be $50,000 or more. Multiply those numbers by 4 years, and you're talking about serious money. How much of that will be paid with student loans? It varies, of course, but the average student loan owed at graduation is over $35,000. Some graduates have larger student loans, some have smaller debt. But think for a moment about the average debt. You'd have to pay back $35,000. That's a car loan or money for a down payment on a home. How much your student loan debt will be and how it will be repaid is obviously critical to your financial future when you graduate. We have 3 fundamental points about student loans as part of your investment in your future. 1, student loans should be your last financing option for college. Again, student loans are debt. They have to be repaid. The money you have to repay could be used for other stuff: a car, a home, savings for a comfortable retirement. Think long term. Take out a student loan only when money from other sources is not available. We're going to talk about other funding sources later on. Number 2, don't borrow more than you can afford. And even more important, do not borrow more than you need. As you are thinking about this, consider 2 things. First, consider the costs of the various options you have. Your favorite college team may be mine, the Florida State Seminoles, which was more fun several years ago. But do you really need to go out of state for considerably more money? Can you start at a local or community college to save money for the first 2 years and then transfer to the more expensive college that has the program that you want? Second, limit the amount of your student loans to what you really need. This means that you have to limit your expenses. Many years ago, my wife and I took our son and a few of his college buddies to dinner. A few of them were anxiously awaiting their next student loan check so they would have money to take a vacation trip. You're a college student. Limit your spending to necessities and be frugal. Keep your student loan down. It will be much easier to buy a car or house when you graduate. And then finally, be smart about the type of student loan you get, federal versus private. Generally, federal loans are more advantageous, and we'll talk more about this later too. So I've said you should consider getting money for college other than through student loans. How do people do that? Here are some of the options. Can we go to PowerPoint 9? One is grants and scholarships. A second is family income and savings, your own income and savings, and assistance from friends and relatives, perhaps with loans they take out and perhaps loans that you will pay back. So let's start with financial aid. The federal government awards about $150 billion to college students in need-based grants. How do you get some of this? It begins with what's called FAFSA, the Free Application for Federal Student Aid. You set up an account with an office of the U.S. Department of Education known as Federal Student Aid and fill out the FAFSA form online, which becomes available on October 1 of your senior year. Filling out the form is a project for you and your family. It requires financial information like bank account information and tax returns if you have been working, and your family will also have to provide financial information and tax returns. You find out the financial aid you will receive for each college that accepts you. Once you're accepted, the college will send you a financial aid letter that tells you the grants you will get, whether you will get work-study funding, if you applied for a scholarship, whether you received it, and finally, federal loans that you are eligible to borrow. Here's an example of an award letter. Note that the total amount of the financial aid is $53,600, but that includes $5,500 in loans and $2,500 in work study. And the total doesn't cover the yearly estimated cost of attendance down there at number 3, almost $64,000. So there's a shortfall from what the college says you can get of over $10,000 that you'll need to make up from other sources: student loans, family contributions, your income. If you have any questions about the financial aid award letter, call the college's financial aid office. Make sure you know whether the financial aid is for every year or whether you have to reapply each year. And if you need more money, ask for it. And then finally, make sure you understand what is free money, that is, money that you don't have to pay back, and what is a loan that you will have to repay. So another way to cover the shortfall is through your employment. You might qualify for on-campus work-study work, usually 10 to 15 hours a week, paid directly to you. Getting a job off campus is another option. Especially, it's good if you can get a job in the field you want to work in when you graduate. This may provide networking opportunities and experience that will help you learn about your chosen occupation and improve your job prospects. Shayna, what are some financial aid options that are available, especially in Georgia?
Georgia has a number of free funding sources for college available to its citizens who graduate from accredited high schools or home study programs and who meet certain criteria, Judge. So students who apply to college from other institutions may still be eligible by meeting other conditions. So HOPE is Georgia's best known state financial aid program. Funded by the Georgia Lottery, it has provided Georgia citizens with college scholarships and grants to almost 2 million public, private, and technical college students during more than 25 years since it began in 1993. It awards a portion of tuition based on the amount of credit hours taken in a given semester. Students must test with a minimum ACT score of 24 or 1160 on the SAT, and the score must be in at least the 75th percentile. You must also have a minimum 3.0 GPA. But even with the HOPE scholarship, there are costs to cover, such as room, board, and extras, such as books, activities, and items such as gym and health fees. And also, HOPE doesn't cover all of tuition, it covers a portion of tuition. So then if you can maintain even a higher GPA and reach for higher ACT and SAT scores, students may be eligible for the Zell Miller Scholarship. The Zell Miller Scholarship will cover all of tuition, and that is based on the number of credit hours taken in any given semester. To be eligible for the Zell, the GPA has to be at least a 3.7, and you need a minimum 26 on the ACT or 1200 on the SAT. But even with the Zell Miller Scholarship, there still are those costs to cover, such as room, board, and extras, such as books, activities, and items such as gym and health fees. So you need to prioritize your education so that you can maintain the GPA over at least the 3.0 to qualify for Hope in the Zell. And this does not end once you enter college. You must still maintain grades in college to maintain funding. So be aware of what you need to do to keep Hope and Zell, both grade-wise and hours-wise. Also, schools have other money available to those who apply early. So the expression that the early bird catches the worm is applicable. Apply early with your best efforts put forth so that you can ensure that you're eligible for all available programs. There are other programs too within Georgia. There's a Hope Career Grant in the amount of up to $500 per term, or a one-time grant of $1,000 to Hope qualified students who enroll in select majors in specific industries. There are other places to look for free money in Georgia. There are special qualifications to meet for each program, so check for eligibility. These include the Georgia Hero Scholarship Program, the Georgia Public Safety Memorial Grant, Reach Georgia, the Student Access Loan Program, which is not a grant, but it's a 1% loan. So it's a fixed interest rate loan, and it's supposed to help college students fill that gap in funding. There's a scholarship for engineering education program if you're interested in engineering. And then there's a Georgia Tuition Equalization Grant Program. So Georgia has a number of really interesting programs to help students meet college costs for those who want to stay in state. For students who are willing to enter the military, there's ROTC. In exchange for paid college tuition and guaranteed post-college career, participants or cadets commit to serve in the military after graduation. And notice you have to commit to serve in the military, and there are time limits on how long you have to serve. Each service branch has its own take on ROTC. It's offered at more than 1,700 colleges and universities across the country. So this one, you're not limited to the state of Georgia, and it prepares adults to become officers in the U.S. military. There are also ways to get into the military academies if you're interested in going that route, and they have their own application criteria that you need to look into. There are 12 colleges in Georgia with ROTC programs. Here are a few more tips as you look for ways to fund college. Ask college counselors, teachers, administration for guidance on whether you should apply for program-specific scholarships like ROTC. Ask your preferred college admissions office for school-specific programs, scholarships, and financial aid packages. And remember that the early birds often win. Some of these programs have very early deadlines, some of them as early as September. So get applications and any required extra essays into the appropriate offices, get them in early and before any deadlines. This also means you need to take the SAT and/or the ACT early, and don't put off that aspect of admissions until senior year. Explore dual enrollment in high school to limit your credit hours taken while at college and maximize the value of your Hope Scholarship. So once you've maximized all these options for free money and you still need money to pay for college, what should you do? So there are a number of other ways to fund college. There are scholarships, there are grants, there are student loans. Student loans are both public and private. Remember that scholarships and grants are free money. That's money you don't have to pay back, although you may need to maintain certain grades once you're in college, or you might lose that money. Student loans are debt and need to be repaid just like a car loan or mortgage on a house. So Judge Bonapfel, can you discuss some of these options?
Well, let's start with, first of all, one source is the federal Pell grant. This is a need-based grant that does not have to be paid back. For last year, it was capped at $6,345. Another source of funds are scholarships other than those that Shayna just mentioned. These may be available at the school that you are going to. They're awarded on the basis of merit, skill, need, or unique characteristics. Again, these are grants and do not have to be paid back. One tip, Don't pay for help in finding a scholarship. Those types of things are usually scams. That's different from working with a guidance counselor that you pay for help in trying to figure out the college maze in addition to your guidance counselor at your high school. So it's worth the effort to search for scholarships. Talk to your high school counselor. Talk to the college you plan to attend. Ask them about what money is available and what sources you might seek out. And then there are various sources on the internet, they're listed on this slide, that you can check to find different scholarship opportunities. But again, don't pay for any of this type of help. Just for fun, here's a partial list of unusual scholarships. So who knows, if you love asparagus, or if you do knitting, or can answer questions about fire safety, you might be able to get a few bucks from scholarships like these. So now we're at what we call the last resort for financing, student loans. Why is this the last resort? Because they're debt and they have to be paid back with interest. So the first question is, what can you afford? As a general rule of thumb, the total student loan debt should not exceed your first year salary after graduation. You can get information about entry-level compensation in your location and on the internet that deals with the type of job that you would be looking for after college. For example, if you graduate with average student debt of $35,000, you will want to make sure that your income for the first year in your post-graduation job will be at least $35,000. Here are some samples of approximate starting salaries. So once you know how much student loan debt you can afford, look at how much you will need to borrow to attend your target school. If the cost is more than the debt you should incur, something has to happen. Either one, you need to get more free money from the school or elsewhere. And remember, ask the college. And your second choice is, if you can't get more free money and it's more than, and what you need is more than what you can afford, choose another school. Don't burden yourself by wanting to go see the Florida State Seminole football team play football by taking on student loan that you can't easily afford. So this next chart works through the process. I'm not sure how well you can see it, but you'll have an availability of getting this deck and you can work through it. So step one, how much do you need? Figure that out. That's the college will provide information about what the tuition and estimated room and board and books and so forth, and then your living expenses. How much do you need? That's everything that it's going to take to get through a year of college. Step number two, how much can you get from sources other than loans? Those are the scholarships, the Pell grants, the other items that we talked about. Three, subtract, and another source might be income that you expect to get from either a work-study program or from a part-time job off campus. So now you know what your sources are other than loans. And step three is simply take the difference. Subtract what you have from other sources to determine how much you need in student loans each year. And then step four, multiply that number by 4 to get to the total amount needed. That seems very simple, but it's a process that you need to go through. Caution. Be aware that it will probably be more than that number you come up with in step 4, because tuition and probably everything else is likely to increase every year. So now you know the total amount of loans that you need. And now the question is, in step 5, what's your projected first year salary? So you fill that in there. And then you compare the total amount of the student debt you will need with the expected income that you hope to get. If the expected annual income is more than the total debt, you're in business. If the expected annual income is less, you have a problem. You either need to do one of two things. First, go back to step 2 and figure out how to get more money from other sources, or find another college where you need less money. Step 7, once you know how much you need in student loans and that you can afford them, you figure out where you can get the loans. They may come from various sources. We'll start with federal loans. Private loans are a last resort. I'll tell you why in a minute. Shayna, what types of student loans are there and how are they different?
Well, Judge, there are two different types of student loans. There are federal loans and there are private loans. Federal loans are those backed by, and that means guaranteed by, funded by, and regulated by the federal government. Private loans are those funded by private entities such as banks and other lenders like credit card companies. They are offered with different rights, obligations, and consequences. Federal student loans have a fixed payment over a 10-year period, 120 payments. Always take federal loans before private loans. It is estimated that more than half of student borrowers fail to max out on government loans before incurring private loans. So you don't want to be one of those borrowers. You want to take and max out your federal loans first. There are 3 types of federal loans. There's the Stafford Subsidized, the Stafford Unsubsidized, and PLUS loans. PLUS loans are parent loans for undergraduate students. That means your parents are involved in them. The Subsidized Stafford loan is a need-based loan. Your school determines the amount you can borrow based on the completed FAFSA. The federal government pays the interest while you're in school and for 6 months after you leave school. This requires that you start paying the loan back 6 months after graduation. The unsubsidized Stafford is not a need-based loan. You are required to pay interest while in school, but you can choose to defer the interest payments. If you choose to defer the interest payments, your interest will continue to accrue, that means to accumulate, and will be capitalized, which means your interest will be added to the principal amount of your loan. So that means your loan continues to grow in size while you're in school. It requires that you start paying the loan back 6 months after graduation. PLUS loans are a need-based loan, again, based on the FAFSA. Parents can borrow. That means you're not borrowing. That means your parents who are saving for retirement are the ones doing the borrowing, up to the cost of attendance, minus any other financial aid award amounts. Parents must also have excellent credit history to qualify for the loan. So there are 5 key features of federal student loans. All interest rates are fixed for the life of the loan. These interest rates reset each year. But once you take out a loan, the interest rate is fixed for that particular loan. So that means if you're in school for 4 years, each of those 4 loans could have a different interest rate, but the interest rate on each loan stays fixed for the duration. As you can see, the interest rate on the PLUS loan is much higher than the interest rate on the Stafford loans. Therefore, besides not involving your parents, you're best off maximizing the Stafford loans. There are caps on the amount of federal loans one can borrow. Annual caps are in the amount of $5,500 to $12,500, and then there's a total cap on the amount to be borrowed. Interest, again, may be deferred while in school, although it may be added to the total balance on the loan. There is a long cure period, that's a grace period, if there's a default in payment after the repayment starts. And this is 270 days. That means if you go into default and you miss a payment, once you go into repayment, you get a little bit of forgiveness. That's a lot longer than on other types of loans. If you cannot make the standard payments on federal student loans, there are many repayment options. For example, there are those options currently available. There are these options currently available. There's an extended plan, which extends the repayment period with lower monthly payments. There's pay as you earn, where you pay only 10% of your income. There's a graduated plan where payments are lower at first and then increase, usually every 2 years, presumably while your salary continues to go up once you start working. There are also loan forgiveness programs for federal student loans, such as teacher loan forgiveness. If you choose to teach full-time in a low-income elementary or secondary school for 5 consecutive years, and public service forgiveness if you are employed full-time, 30+ hours a week in a public service job, such as police, fire, military, and charities. Then there's forgiveness on the remaining balance on your direct loans after you have made 120 on-time monthly payments. So, Judge Bonapfel, what about the private loans?
So a private loan is a loan with a bank or some other financial institution. And it doesn't have the features of the federal loans that Shayna just talked about. It's a loan. It has a principal amount, it has payments, it has interest that is due. So close to 3 million students have private loans with a total amount outstanding of about $120 billion, which is about 8% of total student debt. As I said, private loans are significantly different from federal loans. Usually a parent or someone else perhaps co-signs on the loan and is responsible if the student doesn't pay. 2, interest rates vary depending on credit history. The worse the credit history and the credit rating, the higher the interest rate is going to be. Interest rates can go as high as 25% to 30%. 3, payments begin immediately. There's no deferral on these loans. And there's no right to postpone or extend payments. And there are hair-triggered defaults, meaning a missed payment can result in the entire loan becoming immediately due and payable, and possibly a higher rate of interest due to the default. Private loans create risks and disadvantages. Be careful, use them only as a last resort. And again, make sure that you're going to be able to afford to pay them. And remember, payments on them are going to have to be made while you're in school. As we have emphasized, these loans are debts, all of them, student loans and private loans, or federal loans and private loans. They have to be repaid. What happens if you don't pay? Most people don't think too much about this. Of course you plan on paying. You wouldn't borrow the money if you didn't intend to repay it. But defaults occur, circumstances change, pandemics occur, people get sick. And this defaults occur perhaps more often than you might think. One estimate is that about 1 out of 4 student loan borrowers is in default on more than $175 billion in student loan debts. That's a 1 in 4 chance of a default. And it starts early. About 10% of federal student loans were in default within 2 years after payments must begin. So what happens if you default? Well, the lender can sue and get what's called a judgment. That's a judicial recognition that you owe the money. And it puts what's called a lien on your property. If the lender gets judgment and the lien, it can then garnish your wages or bank account. That means it can take money that your employer would pay you and make the employer pay it to them. Or if you've got money in the bank account, it means they can take it and get it out of your bank account. In some circumstances, a creditor can enforce a lien by causing the sale of your property. In the case of federal student loans, income tax refunds that you're owed can be applied to the debt that is a federal loan. If you're in default, you may not be able to renew professional licenses, and this adverse credit will be on your credit report, and that may have disastrous consequences for getting credit cards, for taking out auto loans, a home mortgage, a rental apartment, even a job. Interest rates will be higher on, for example, cars and houses, assuming that you can get such a loan. And as a general rule, you can't get rid of a student loan in bankruptcy. Student loans are accepted from the effect of bankruptcy. Only about 1% of student loan debt gets eliminated in a bankruptcy case. So let's wrap this up. What have we been saying? Number one, look for funding for your college expenses from sources other than loans. Part of this is fill out the FAFSA form early, apply for grants and scholarships early and often, search out the specialty ones and the unusual ones that we talked about. Talk to your college aid officers as well as your high school guidance counselor about what types of financial aid can be available. Number two, figure out how much in student loans you can afford. I can't emphasize this enough. You want to take on a lot of debt if you're not going to be able to pay it back based on the income that you expect to have after you graduate. Know your expected income and don't borrow more than the expected first-year salary. Number three, if you need loans, get federal loans first, private loans last. And we've talked about all of the reasons for that. Payment terms and the interest rate on the federal loans are going to be much better for you than private loans. Number four, borrow only what you need. What you need is different from what you want. Carefully consider if the amount you need to pay for the college you really want to go to will require student loans beyond what you think your salary is going to be when you graduate. Think carefully about whether that college is worth it. There are lots of colleges out there, and you do not have to go to the one you've always wanted to do to succeed in life and to come out of college with a manageable debt instead of a burdensome one. In other words, if what you can afford is less than what you want costs, change your wants or find other sources for getting what you want. 5, don't miss a payment. Default is expensive. It can result in additional interest charges with a higher rate. And as we noted earlier, it gets put on your credit rating, and that will mean that you'll have to pay more interest on other types of loans. Be aware that there are workout programs, especially with the federal loans. If you expect that you can't make a payment, take the initiative to contact the lender to talk about resolving the problem. Thank you very much for listening to us today. We hope we've been helpful. Good luck with your college search, your application process, your college studies, and your future career.